Assalamualaikum and hello everyone. My name is Muhammad Ferhad Radzwan and I with my friend Muhammad Aiman Muhammad Fairuz and Niresh Kunaselan. Today we are present about theory and practice of Islamic financial intermediation based on chapter 2 of the book risk analysis for Islamic bank. This is part of our risk management course and we are excited to share highlight concept about how Islamic bank operate differently from conventional bank. Next is highlight. First of all, Islamic finance is rooted in contract, not interest. The Mudarabah contract from the backbone of Islamic intermediation. In this system, depositor are considered investor, not lender. And bank use various Sharia compliant instruments like Murabahah, Ijarah, and Musyarakah. The Islamic financial industry is also growing rapidly, including investment bank, takaful provider, and Islamic mortgage firm.
What is Islamic financial intermediation? Islamic financial intermediation refers to connection fund provider like depositor with fund user like business in a Sharia compliant way. Unlike conventional systems that rely on interest, Islamic bank use profit and loss sharing mechanism. They act as trust or mudarib on behalf of investor. Next, key contracts in Islamic intermediation. These are the core contracts used in Islamic banking. Mudharabah is a trust-based partnership where one party provides capital and the other manages the business. Murabaha is the cost plus sale used for financing. Ijara is similar to a leasing, and Musharakah is a partnership where both sides invest and share profit or loss. Next, structure of financial statement. The financial statement of Islamic bank differ from conventional bank. On the liability side, we have demand deposit, which earn no return, and investment account based on Mudarabah. On the asset side, bank use trade financing, leasing, and equity-based investment to deploy funds in a Sharia compliant way.
Let's look at how an Islamic bank's balance sheet is structured. Islamic banks use two different ways to present their balance sheet, by maturity profile and by functionality. First, in maturity profile, assets are grouped as short-term, medium-term, and long-term. For short-term, like trade finance using murabaha or salam. For medium-term, such as leasing contracts like ijaraha. For long-term, we have equity-based investments such as mucharaka. On the liability side, we have demand deposits or better known as amana. These are repayable anytime with no return to depositors. Investment accounts or mudarabah, these are profit-sharing accounts where depositors invest money and share profits together. But if the business encounters loss, they share the loss together. The second view is based on the function of assets or liability. For example, assets are classified as financing, investment, or fee-based services. Liabilities still include the same deposits, but are by how they function for the bank. This structure helps us understand what kind of risk the bank is exposed to based on time and purpose of the funds. Does all this mean in terms of risk? The way Islamic banks manage funds directly impact the risk they face, whether it's short-term or long-term equity contracts. In short-term contracts like Murabaha are safer but less profitable, whereas for long-term like Musharak carry more risk and uncertainty. Islamic banks also face credit risk, liquidity risk, and operational risk. Credit risk, the risk that customers don't repay. Liquidity risk, the challenge of meeting withdrawals on demand. For operational risk, risk from internal systems, processes, or Sharia non-compliant. But unlike conventional banks, Islamic banks must also ensure all risks are handled according to Sharia. Islamic financial intermediation avoids interest and works through contracts. Depositors are investors, and banks act as a trusted partner using instruments like murabaha, ijaraha, and mudarabah. The balance sheet structure reflects both the nature and the maturity of these contracts. Displaced commercial risk is a major real world issue as it shows the tension between theory and practice. Managing risk in Islamic banking isn't just financial, it's also about maintaining Sharia compliance and public trust. That's the end of my part of my presentation. Thank you for listening. If you have any questions to us, my team, please, me and my team are happy to answer them. Thank you.